In the world's financial markets, trillions of dollars move every single day. And into this arena steps the retail trader, armed with a whole arsenal of common indicators and strategies, all designed to predict the market's next move. And yet, the vast majority of them fail. This isn't really a question of luck, it's a question of mechanics.
You see, the reason for this failure might just lie in a completely flawed premise. There's an old piece of wisdom, one that's often ignored, that suggests a totally different way of looking at things. It says the market doesn't reward predictions. It rewards those who understand its movements. And that single idea, well, that's what separates two entirely different views of the financial world.
On one side, you have the illusion, a world of popular indicators, a constant attempt to predict the exact tops and bottoms. This is the world that most people are taught. But on the other side, there's a different reality, one that's understood by institutional players. It's a world driven not by signals, but by the hunt for liquidity, the cold logic of market structure, and the raw story of price action itself. Welcome to TRADEVERSE. Our work is to unpack these hidden dynamics. In this analysis, we're going to examine the anatomy of that conventional failing approach and document the paradigm shift that's required to see the market for what it truly is.
Our investigation starts with the phenomenon that's common to almost every new trader, this powerful illusion of control.
For most, the journey begins as a search for a holy grail, some perfect predictive strategy. Traders cycle through a really familiar set of tools, don't they? RSI, MACD, Bollinger Bands. Each one promises to bring some clarity, a way to put some order to the chaos of the market. But it's a promise that, systemically, just doesn't deliver.
Our source material documents this perfectly through the case of a trader. Let's call him Ethan. He saw what he thought was a perfect setup, a textbook RSI divergence, everything confirmed by his other indicators. So he placed his trade, feeling pretty confident. And then, in an instant, price just smashed right through his stop loss. That textbook setup, it was actually a trap.
This kind of repeatable failure forces a really critical question. It's one that confronts every trader who goes down this conventional path. Was the market's behavior just random, an unpredictable force of nature? Or was it something else? Was it engineered?
The answer to that question doesn't lead to a better indicator. It leads to a profound paradigm shift. You see, the turning point for Ethan didn't come from adding more complexity. It came from subtraction. That night, he deleted every single indicator from his charts. All the analytical noise just vanished. And for the first time, he was looking at the market's raw data, completely unfiltered. And in that newfound clarity, a new governing principle started to become visible: liquidity. This is the true fuel of the market, not abstract signals, but these huge, measurable pools of buy and sell orders, often clustered right where retail traders place their stop losses. And institutions, they actively target these zones to fill their own massive positions. And that was the revelation. The market wasn't random at all. Its movements were precise. It was actually engineered to seek out these pools of liquidity, exploiting the predictable behavior of everyone using the same textbook strategies. In this system, the weak hands were simply feeding the strong.
So, with all the indicators gone, a more direct analysis was now possible. He started to learn what's known as the language of price. The first element of this language is structure. He learned how to identify a break of structure, or BOS. Now, this isn't some interpretive signal, it's a clear, objective event. It's when price moves decisively past a previous swing high or low. Think of it as a footprint, hard evidence that the underlying momentum could be shifting.
A second element was something called the fair value gap, or FVG. These are observable inefficiencies right there on the chart, gaps that are created when price moves too quickly in one direction. These imbalances in price rarely last. They often act like a magnet, drawing price back to rebalance the area before it continues its move. Again, this isn't a prediction, it's an observation of pure market mechanics. This new framework represented a fundamental change in his objective. The goal was no longer to prophesy the market's next move. The entire mission shifted from prediction to understanding.
The methodology that comes from this can be boiled down to a simple four-part logic. First, you abandon the goal of prediction. Second, you remove the indicators and all the analytical noise they create. Third, you learn to follow the institutional footprints by identifying where liquidity is most likely to be. And fourth, you learn to read the language of price through objective concepts like structure and value gaps.
And so, the journey comes full circle, right back to that core principle that started this whole shift in perspective. The market doesn't reward predictions, it rewards those who understand its movements.
Ultimately, the objective is not to have a crystal ball. It is to develop the clarity to read the story that the market's price action is telling you, right here in the present moment. And that is the difference between guessing the future and analyzing the now.